No one is immune from investment mistakes, but beginners are particularly susceptible to them. Some of these mistakes are so obvious that you've probably heard about them even without being involved in the world of investments. Others are less apparent and fall under the so-called pitfalls that even experienced investors may encounter. Investment mistakes vary in nature and consequences. However, they share one commonality. They continue to occur and will continue to do so, making them always relevant. Whether you use the services of a financial advisor or act independently, you should be aware of and consider them. Beginner investors often believe that simply investing guarantees solving all their financial problems and challenges. This feeling may arise if they take seriously the promises of many investment advisors who are interested in their investments. However, assuming that everything will be perfect is at least naive. If the stock market predicts one thing in the near future, and advisors paint an overly bright and optimistic picture, it's reason to pause and formulate more realistic expectations on your own. One of the main mistakes private investors face is the lack of portfolio diversification. From childhood, everyone knows, don't put all your eggs in one basket, and numerous experts continue to remind about the need to spread risks. The irony is that people using basic tools like bank deposits strictly adhere to these rules. However, when they enter the stock market, they often forget this principle. Private investors are usually familiar with the concept of diversification and understand its importance. Observing their actions in the market, it's hard to understand why they forget about it. Portfolio diversification should occur across industries, types of instruments, and investment horizons. It's also important to consider credit risks. A general principle is that for moderately conservative investors of middle age, the ratio of stocks to bonds in the portfolio should be approximately 50-50. I buy mutual funds or ETFs for diversification. Such funds already contain broad diversification in their structure, and the investor buys only a portion of the overall portfolio. This is quite easy to do since the entry barriers are low. However, even with such diversification, there are pitfalls. A private investor may purchase an index or sector fund which provides good diversification, but the effectiveness of such operations can depend on the timing of market entry and exit. Studies show that private investors often buy funds when their price is already close to its peak. Even if the fund is good and promising, can the private investor withstand a significant market drop of 20-40% and wait for their profit? Another common problem is motivational. Private investors often confuse speculation with investment. It's important to understand that speculation and investment are two different strategies. Speculation is based on short-term forecasts and attempts to profit from price fluctuations in the short term, which can lead to significant losses if the forecast is wrong. Investments, on the other hand, involve a long-term approach focused on asset value growth in the future. Investing requires careful analysis and understanding of market trends. It's not just about buying and selling stocks or bonds, but a strategy based on fundamental analysis of companies and economic data. Private investors often support a steady income strategy based on regular receipt of dividends or interest from bonds. However, such an approach requires not only patience but also a deep understanding of the market and chosen assets. For example, an investor may purchase shares of a company with a high dividend yield. This seems like a good strategy if the company consistently pays dividends. However, if the company's profit sharply declines due to changes in its industry or the country where it operates, the level of dividends may significantly decrease or be cancelled altogether. Private investors should consider not only current financial indicators of companies but also their prospects for the coming years to avoid losses. Private investors often neglect company and fund analysis due to lack of time or knowledge. However, this is a mistake that can lead to serious financial losses. I advise all investors to pay more attention to fundamental analysis. This will help avoid many market pitfalls. Fundamental analysis involves studying companies' financial reports, their long-term strategies, competitive environments, and market trend forecasts. The deeper the analysis, the more justified your choices will be. Despite all the advantages of fundamental analysis, private investors often prefer to follow broker advice or news headlines. This can also lead to mistakes. News headlines can be useful for understanding the current market situation, but they often do not reflect long-term trends and fundamental factors. I recommend investors to analyze not only the news itself, but also its impact on financial markets and companies. I suggest using various sources of information to get a comprehensive picture of the market and minimize risks. If you want to build your initial capital but feel that you lack financial literacy and knowledge of investment strategies, I invite you to subscribe to my channel and write the word investment in the comments. I will send you a detailed investment guide and an effective strategy with 3 ways to invest your money so that it generates passive income for you throughout your life. Money will actually start accumulating in your accounts, and there will be more of it. Check it out. Write investments in the comments and start learning.